Imagine you own more money than you could ever earn back. You can't work more hours. The interest climbs every single month. So you do the one thing an ordinary person can't, but a sovereign monetary system can. You create more money. Now, picture the printer bolted shut. Every new dollar has to remain credible against a finite stock of gold, mined, melted, weighed, and guarded underground. How do you pay the debt now? For much of modern monetary history, that wasn't a riddle. It was the constraint governments lived under. Then, across one weekend in 1971, the most powerful country alive cut the dollar's final official link to gold. Here's the real question. What would the world look like today if America had never done that? What if the dollar were still chained to gold? Let's start with what that chain actually was. A gold standard is a simple promise with a hard edge. A country fixes its currency to a set amount of gold and commits to exchanging money for metal under the rules of that system. After the Second World War, the whole world built its money system on one version of that promise. It was called Bretton Woods, struck in 1944. Other countries pinned their currencies to the United States dollar, and the dollar, in turn, was pinned to gold at a fixed price, $35 an ounce. But ordinary Americans could not simply demand gold. The official promise mainly applied to foreign governments and central banks holding dollars. That one rule did something invisible but enormous. It placed a hard constraint on how freely the United States could expand the supply of dollars while defending the fixed gold price. Credit could grow. Banks could lend. But if too many dollars accumulated abroad, foreign authorities could demand gold, and the vault would begin to empty. So picture a government that wants to spend more than it collects in taxes. Under fiat, the system we live in now, it has options. It can borrow, and during a crisis, the central bank can create reserves and liquidity to keep things moving. Under gold, that last door is much narrower. You can tax, you can borrow, you can raise interest rates, change the gold price, or suspend convertibility. But you cannot expand money without considering the metal and the promise behind it. That's the whole mechanism. Everything else follows from it. So what actually stops a country from just printing anyway? Under fiat, there is no physical ceiling. The limits are inflation, interest rates, law, politics, market confidence, and the judgment of the central bank. Under gold, the answer becomes physical as well. If you create more dollar claims than foreign holders believe you can honor, they can ask for the metal. And once the vault starts emptying, the bluff is over. You tighten policy, change the promise, or admit that the old price cannot survive. That second possibility is exactly what cornered the United States. Through the 1960s, America spent a war in Vietnam, ambitious programs at home, foreign aid, military commitments, and investment abroad. More dollars flowed into the world. But remember the rule. Every official dollar held overseas was still linked, on paper, to American gold at $35 an ounce. By the late 1960s, foreign governments did the math faster than Washington wanted them to. They could see more external dollar claims than the United States could convert at the official price. So they began trading paper dollars back for metal. France was among the most visible. The vault drained. By the summer of 1971, the United States could no longer credibly cover all foreign dollar claims at $35 an ounce. The gold was leaving, and confidence was weakening. On August 13, 1971, President Richard Nixon took his closest financial advisors to Camp David for a secret weekend. They stared at the same math everyone else had been staring at. And on August 15th, before the markets opened on Monday, Nixon went on the air and suspended the dollar's convertibility into gold. Temporarily, he said, the fixed gold window never reopened. By 1973, the major currencies were floating. Now here's where almost everyone's instinct is wrong. Ask most people what staying on gold would have done, and you'll hear the same answer every time. Hard money, strong dollar, discipline, no inflation, fewer crises. A stricter, safer world. The historical record says something more uncomfortable. In 1981, economist Michael Bordeaux examined the classical gold standard in the Federal Reserve Bank of St. Louis Review. His conclusion was not a simple disaster story. Before the First World War, Gold often delivered strong long-run price discipline and supported expanding trade and capital flows. But later research exposed the other side. In 2003, Michael Bordeaux, Robert Dittmar, and William Gavin found that modern inflation targeting could deliver more short-run price stability than a gold standard. And research on the Great Depression associated with Barry Eichengreen, Ben Bernanke, and others found a brutal pattern. The longer countries stayed tightly committed to gold, the deeper their depressions tended to be, and the later their recoveries began. Here's the part the comfortable story leaves out. The gold standard didn't prevent crises. It reduced the room to cushion them. When a crash came, the government had less freedom to create liquidity without risking the gold promise. So instead of managed slowdown, you could get the raw version: collapsing prices, bank failures, mass unemployment, and no easy hand reaching in to stop the fall. Over long stretches, your money could hold its value more firmly. In the short term, your life could still be flattened. That's the trade nobody puts on the poster. Now, play it forward. A real crisis hits. 2008, 2020. Under the system we actually have, what does a central bank do? It creates liquidity. During the first months of the pandemic, the Federal Reserve expanded its balance sheet by about $3 trillion through asset purchases, lending facilities, and other emergency actions. Now, run the exact same crisis in the world that stayed on gold. What can that government do? Far less. Unless it suspends convertibility, revalues gold, borrows reserves, or accepts a run on the vault. To create liquidity on that scale while defending a fixed gold price, the United States would need an enormous reserve cushion, a dramatic revaluation of gold, or both. The keyboard isn't completely disconnected, but every keystroke pulls against the vault. So in 2008, and again in 2020, a gold standard America most likely takes the hit harder. Deeper deflationary pressure, more bank stress, slower emergency support. It may emerge with less public debt. It may also emerge with more failed companies, more unemployment, and a longer scar. Which brings us to the question underneath the whole counterfactual. Without the printer, does America still end up running the world? The instinct says no. Surely the flexible superpower wins. But the dollar's dominance was never really about gold alone. It rests on things gold can't touch. The largest economy on Earth for most of the period. The deepest, most trusted financial markets anywhere. Powerful legal institutions. An enormous supply of safe assets. Unmatched military reach. And the quiet power of habit. Oil priced in dollars, trade settled in dollars, and the whole world's plumbing already wired through them. Keep all of that, keep gold, and the most likely path is that America stays the dominant power anyway. Just a leaner version of it. More disciplined, less able to spin its way out of trouble, and far less willing to run the kind of deficits that, in our timeline, push total United States public debt past $39.3 trillion by late June 2026. Debt could still exist under gold, and it could still become large. But sustaining today's scale in today's dollars would have been much harder without changing the gold price, restricting convertibility, accepting deflation, or abandoning the system during a major war or crisis. And here's where it gets interesting. Because America isn't the only one this changes. If you're sitting in Beijing, watching a rival that cannot create dollar liquidity as freely during a bad year, where is your opening? In our actual timeline, China's rise was supported, in part, by an enormous appetite for American paper. China sold goods, took dollars, and parked a share of them in United States assets. America, in return, supplied the world with deep markets and enormous quantities of dollar debt. That loop spins more easily when one side can supply safe dollar assets at vast scale. Put America back on gold, and the loop tightens. Washington faces stronger limits on persistent external deficits and on the scale of safe dollar assets it can supply. The export-led path China actually walked gets narrower, harder, slower. My sense is that a rising China still rises, but against a leaner, more constrained America inside a slower and tighter financial system. What it doesn't do is make the world simpler. Credit can still expand under gold. The gold price can change. Governments can suspend the rules or leave the system when pressure becomes unbearable. But countries losing gold would face harsher choices: raise rates, cut demand, accept falling prices, seek emergency loans, or break the promise. Developing economies might find foreign financing scarcer in crises and more dependent on the policies of the gold-rich powers. Every gain has its bill. So where does the analysis actually land? The way the pieces line up, a gold standard America most likely keeps the crown for much of the period, but holds it with a harder, more brittle grip. Stronger, long-run monetary discipline. Weaker shock absorbers. Probably less debt. Probably less ability to rescue the system when everything breaks at once. And the thing to watch in our own timeline isn't one day's gold price. It is whether central banks gradually reduce their reliance on dollar reserves while adding gold and other assets. The dollar still represented about 56.8% of allocated global foreign exchange reserves at the end of 2025. It remained dominant, but its share had been drifting down over the long run. A sudden coordinated flight from United States debt would change this picture. A slow diversification does not end dollar power, but it shows that other countries are buying insurance against it. Because that's what really changed on that weekend in 1971. It wasn't just a financial rule. It was a swap. America traded the discipline of gold for greater freedom to create liquidity, run deficits, fight wars on credit, and soften crashes. That freedom also created more room to owe. Nothing broke loudly the day the chain came off. The dollar still spent the same on Monday as it had on Friday. It simply stopped being a promise about a fixed amount of gold and became a promise about the strength, institutions, and judgment of the United States itself.